and we will answer them at the end of the session. Also, if you encounter any technical issues throughout the webinar, please exit and rejoin, and that should resolve any issues. This session is being recorded, so the slides and that recording will be made available following the presentation. Additionally, our presenters' contact info will be presented on the slides, and I encourage you to connect with them and make sure to follow Bateman McKay on LinkedIn to stay up to date with all of our future webinars and other content. With that, I will pass to tax partner Richard Rizzo to get us started.
Good morning, everybody. Thanks, Chris, for the introduction. I'd just like to welcome everybody to another episode of Breakfast with the Tax Team. I hope you all enjoyed the beautiful weekend we had. The topics for today, well, Krista Burch, one of our tax managers, will be giving us a quick update on the 2021 federal budget. Whilst on surface it seemed to be kind of a bit of a very little in there, there's actually quite a bit of detail once you get into the grits of it. So, and then Michael will be giving us a quick update on the COVID benefits as a result of the budget. And on that note, I'll hand it over to Krista to get started. Thank you.
Thank you, Richard. Good morning, everyone. So as Richard said, I'm going to be going over the 2021 federal budget. So with incredible timing for all tax practitioners, it was released on April 19th of this year by Chrystia Freeland. So with most of it aimed towards being a recovery for jobs, growth, and resilience. So as Richard mentioned, this was actually quite a robust budget. It was quite lengthy, not a ton of tax per se, but a lot of economic stimulus. So a plan to bridge Canadians and businesses through crises towards robust recovery, generational investment to build a Canada-wide early learning and childcare system, and to drive economic growth to offer each child the best start in life. There's also a lot of green recovery initiatives, specifically geared towards those that fight climate change and forecasts. The budget forecasts a deficit of $354 billion for this year, decreasing to almost $55 billion for 21-22. So the highlights we're going to be going over this morning. So no real changes to any personal or corporate tax rates, with the exception to one small one geared towards climate change. The extension for COVID subsidies, so I will not be discussing this, but it was a focus of the budget, but Mike Cosentino will be going over this in detail after I'm completed all other budget updates. The immediate expensing of capital property acquisitions, which is a large one, especially for small business owners. Enhancing of mandatory reportable transactions. This may not impact everyone. This is more geared towards tax practitioners as well as those entering into reportable transactions, but the disclosure rules are increasing for these. The details of proposed digital services tax, sorry. The limitations on interest deductibility. There's a luxury tax, which will probably impact most individuals of everything from this budget, and tax on unproductive use of Canadian housing by foreign non-resident owners. So to start, the immediate expensing of capital property acquisitions. So this is, the government is allowing $1.5 million per taxation year on eligible property acquired by CCPCs, so Canadian private companies. So anything purchased after April 18th, 2021, that is ready for use by the beginning January 1 of 2024. So eligible property includes all depreciable property other than buildings, roads, parking lots, and classes 47 through 51, which is basically natural gas. So any equipment is on the table to claim the full 1.5 million as opposed to capitalizing it and having to amortize it at 20%, which is your typical amortization rate. The $1.5 million is to be shared among associated groups. So if you have more than one company, the 1.5 million is for all companies in that associated group, but it is available per taxation year. If you do not spend the full 1.5 million in year one, it does not carry over. So if you intend to spend more than 1.5 million, it needs to be spent on an annual basis. Capital cost allowance for clean energy equipment. So this was the government's way to increase the assets available for clean energy. So that includes solar, wind, hydroelectric. So they're expanding the classes to include additional properties, as just mentioned. They're also removing eligibility on fossil fueled and waste fueled systems. So again, these classes exist for accelerated amortization. Some are 30%, I believe some are 50%, depending on the class, as opposed to the regular 20% amortization for other equipment. Your film and video production tax credits. So this doesn't impact a lot of our clients, but the CPTC and the PSTC were credits that have always existed. What the government has proposed is essentially to extend those deadlines by 12 months. So any film or video production that was on hold due to COVID will hopefully still benefit from the extended credit limitation period. Digital services tax. So again, this is probably not going to impact a lot of people you know, but it's a 3% tax effective January this coming year of January 1, 2022. It applies to online businesses that have global revenues in excess of 750 million euro, so over $1 billion Canadian, and have revenue related to Canadian users of at least 20 million or more. And if you qualify for that, then you have an additional 3% tax that you have to pay on any related revenue. So again, this is the digital service tax credit is computed on an associated basis. So if you have more than one company, the threshold sticks for all companies combined. And it actually, the tax will be a deductible expense for income tax purposes. Rate reduction for zero emission technology manufacturers. So this was what I alluded to earlier when I said that the only real corporate tax changes applies to this. So what this proposes is to temporarily reduce the small business rate from 4 to 4.5% from 9%, and the general corporate rate down to 7.5% from 15%. So quite a bit of savings here. Now to qualify, you have to have at least 10% of gross revenue from business carried on in Canada, and it must be derived from eligible zero emissions technology manufacturing. So that means, you know, solar equipment, wind energy, zero emission vehicles, you have to be involved in the manufacturing of that equipment. The interest deductibility limits, so the limit of interest expense deduction for more than 40% of EBITDA in year one and 30% of EBITDA year after. This is primarily to deter structures where you're claiming revenue in one jurisdiction and claiming an expense in the other. CRA doesn't want large interest expenses being claimed in Canadian corporations where the revenue may not necessarily be paid, or the tax may be paid. So the limitations are intended to apply where excess interest is created through interest payments to related non-residents in low jurisdictions. So the use of debt financing to earn non-taxable income and having Canadian businesses bear the disproportionate burden of the third-party debt. So they're just basically trying to cap your interest based on your EBITDA. Again, the rules applies to corporations, trust partnerships. However, CCPCs with taxable capital of less than 15 million. So if you basically qualify for the small business deduction, you're under the $15 million taxable capital threshold, and you have an aggregate expense of $250,000 or less, you do not fall into these criteria. So you only have to worry about this if you do not qualify for the small business deduction on an associated group level, and if you have more than $250,000 in interest expense. The enhanced mandatory disclosure rules. So CRA now is basically, they will have the opportunity, and these rules have always existed, but they're restricting them more. So they're going to have the opportunity to basically, the taxpayer has to come forward and report what is happening. So there's reportable transaction rules, there's notifiable transactions, and uncertain tax treatments, all which I'm going to discuss. But basically the onus is on the taxpayer to come forward and report what type of transaction they're entering into, provided the CRA has listed that type of transaction on a given list. So all of these rules that they've tabled, there aren't any guidelines around them yet, so we aren't quite sure what they're going to look like, but we basically have an understanding that it's going to be, you know, those types of tax transactions that a lot of people are entering into that are a little more risky, and we don't really know why CRA wants this. It might be for audit purposes. It could also be to bring it to, you know, to bring it to the government to basically have the feds shut down certain loopholes for people that are taking advantage of, you know, common transactions that, you know, CRA wants to stop but needs the government legislation for it. So the mandatory disclosure rules. So the Income Tax Act currently requires reporting of transactions if it's considered an avoidance transaction, and if it meets 2 of the 3 defined hallmarks. So the 3 hallmarks are if a contingent fee is received, if there's contractual protection, and if there's confidential protection. So if you have 1 of the 3, previously you didn't need to report, but if you had 2 of the 3, you were required to report it as it was considered an avoidance transaction. So there is a new requirement now that if you have at least 1 of the 3, you have to report that transaction. And they're also proposing to amend the definition of an avoidance transaction so that it includes transactions that can reasonably be concluded that one of the main purposes is in entering into a tax benefit. So previously it was always, as long as you had a business reason, they're looking to change that wording to say that it doesn't really matter anymore if you have a business reason, provided one of the main reasons was to obtain a tax benefit. So the reporting of such schemes by promoters and advisors is also required, and the failure to report will be subject to penalties for both the taxpayer and the promoters and advisors. So the new notifiable transactions, these will include transactions that CRA is found to be abusive and transactions identified of interest. So as I've said, we don't know what those are yet. The details and fact patterns or outcomes will be provided in sufficient detail so that taxpayers are able to comply. The requirement to report to CRA is within 45 days from the earlier of the taxpayer becomes contractually obligated to enter into the transaction or enters into the transaction. So we don't really know what this will look like, but I mean, from what we gather, that to me says, you know, there's going to be no backdating of these types of transactions, because if we backdate, you know, 2 months, you've already missed the 45-day deadline. So this looks like this is going to be a very tight deadline. And essentially, as mentioned, you know, that there's penalties if these transactions aren't reported, and what they can also do is waive the statute bar period. So failure to not report these transactions will not save you from an audit if it's picked up 5 years from now, as the statute bar period will be waived. Uncertain tax treatments. So these are tax situations where the following conditions are met. So the corporation files a Canadian income tax return. Corporations have at least 50 million in assets at the end of the year. The corporation has audited financial statements in accordance with IFRS. So most Canadian businesses are not under IFRS. They're usually under ASPE, I believe. So this may not apply to a lot of CCPC companies. But overall, if you meet those criteria and there is an uncertain position related to the corporation's Canadian income tax reflected in the audited financial statements, this has to be disclosed. So corporations will be required to provide a quantum of the tax issue, a description of facts and tax treatment taken, and whether uncertainty relates to a temporary or permanent tax difference. So basically, you just need to provide a disclosure that will be due with the filing of the return. And penalties of $2,000 per week to a maximum of $10,000 if you fail to comply. So the reassessment period. So to support the new disclosure rules, it's proposed that the normal reassessment period will not commence in respect to the transaction until the taxpayer has complied with the applicable reporting requirements. So as I mentioned, your statute bar period is essentially waived. So if the taxpayer does not comply in respect of the transaction, the reassessment in respect of said transaction will not become statute barred. So that's a big one. So we need to make sure that we are reporting all of these transactions once the criteria has been released. So on to some personal tax measures. So the Canadian working tax benefit. So they have decided that we will be ramping up, beefing up our Canadian working benefit. So increasing the phase-in rate from 26 to 27% when working income is in excess of $3,000. Increasing the phase-out thresholds for singles from 13 to 22, almost 23,000, and individuals eligible for the DTC, the disability tax credit, from 24 to 32,000. Also, they'll be increasing the phase-out for families, so that will go from 17,000 to 26,000, and families eligible for the DTC from 37,000 to 42. So the working income tax benefit is essentially just an additional credit that you receive based on your income. And what the government has tabled is that they are increasing these thresholds so that if you previously, were starting to get a reduction in your working income tax credit at the start of 13,000, it's now almost 23,000. So this is definitely beneficial for lower income Canadian working individuals and families. The disability tax credit will also be expanded. It will be expanded to include additional mental functions for everyday life, so that hopefully that more individuals will qualify for the DTC. And it also reduces the therapy component. So previously there was a therapy requirement of 3 times per week, and that is now being reduced to 2 times per week in order to qualify. Repayment of COVID benefit amounts. So what CRA basically came out with before, they were saying that if you received a COVID benefit that you were not entitled to in 2020, you had to repay that amount. If you did not repay that amount until 2021, you still had to include it on your 2020 tax return, and then you could take an offsetting deduction in 2021 for that amount, which may not necessarily be fair, especially if your income was higher in 2020 than it is in 2021. So the budget proposed that you actually now have an option. So if you want to take the deduction in 2020, you can. You just need to amend your return. So you are able to take a deduction for the year in which the income was received, provided that you repay it by 2023. Electronic delivery of CRA correspondence. So this is just allowing CRA to send notice of assessment electronically to taxpayers with consent from individuals who electronically file their returns. The luxury tax. So this was a big one. So the tax on luxury cars, personal aircrafts, and boats. So tax on cars and aircrafts in excess of 100,000 and boats in excess of 250,000. As of this coming January of 2022, there will be a luxury tax, which is calculated as the lower of 20% of the threshold and 10% of the full value of the car. So essentially on a new car, if you have a $100,000 purchase, you'd be looking at the lower of, so you'd be looking at a $10,000 luxury tax. Yeah, so there's an additional tax on these, and I guess this is basically the federal government's way of trying to tax those with additional money. But you know, it's not very hard to spend 100,000 on a car. It's not a luxury I have, but I know lots of people that have them. So watch out for that on your next purchases. The GST new housing rebate, this is a small one as well, but the new housing rebate exists for anyone that is charged HST on a new build. So this is primarily for personal residents, but also applies to rental properties. But for personal, there was always an issue if one or more persons were on title. All purchasers in the past had to be using that property as their primary residence in order to qualify for the rebate. So the proposed changes include that provided one person on title will be using it as primary residence, the purchase will qualify for the rebate. So this is effective for all agreements entered into for April 19th, 2021, and any home substantially completed after April 19th, 2021. And then finally, we have our tax on unproductive use of Canadian housing by foreign non-resident owners. So this is going to be a 1% tax on any non-resident owned, non-occupied residential real estate that's considered to be vacant. This will be assessed on a yearly basis based on the fair market value of the property. And the foreign non-resident owners will be required to file an annual declaration. So again, this is trying to target empty homes that are owned by non-residents, and a 1% tax on, you know, a $600,000 condo can add up pretty quick when it's an annual tax. And then we have the other measures, which is CRA's budget. So $230 million over the next 5 years will be allocated to CRA to improve its ability to collect outstanding debts. $330 million over 5 years will be used to invest in new technologies, so IT infrastructure and dealing with ongoing cyber threats. $88 million over the next 4 years in expanding the capacity of Canadian digital service. And with that concludes the budget update, and I will pass to Michael Cosentino, who will go over the COVID-19 program updates.
Thank you, Krista. Good morning, everyone. And as Krista mentioned, I am going to be going over some of the COVID-19 financial programs available, some of the updates to the program since from the 2021 federal budget, as well as some recent updates. So the main four programs that I'll be speaking about today are the Canada Emergency Wage Subsidy, the Canada Emergency Rent Subsidy, the Canada Emergency Business Account, and then as well as the proposed Canada Recovery Hiring Program that was just recently proposed in the 2021 federal budget. So we're going to start off with the Canada Emergency Wage Subsidy, or CEWS. And the objective of this program has been to allow employers to retain and pay their employees during the course of the COVID-19 pandemic. It's since March 15th, 2020, businesses have been able to apply for the CEWS in predefined 4-week increments. And just some statistics to date on the CEWS program. So they've seen 3,361,540 applications approved from just over 444,000 unique applicants. And as a result, the program has paid out almost $78 billion of subsidies as of May 9th. So what is the future of CEWS? So right now, the current rules for the CEWS program are in effect until June 5th, 2021. So currently, the maximum subsidy available under CEWS is going to be 75% of wages paid up to $847 per employee per week. And that's going to be for your hardest hit businesses that get that 75%. So the hardest hit businesses, those are your businesses that have a revenue decline of at least 70%. The 2021 federal budget is proposing to extend the program until September 25th. And they can actually further extend the program to November if it's necessary, if the COVID-19 pandemic still raging on, they have that ability to extend. Now, the maximum subsidy rate, they do plan to gradually phase out the program in terms of how much businesses will get back from the program, and in order to slowly bring this program to a close. If you recall, last summer, the federal government did try to do this, but when we got to about October last year, that's about when we got hit with the second wave of the COVID-19 pandemic. So the government halted their phase-out plans then, and the program's been continuing on since then. Now, right now, the current CEWS rules allow for any business that has any revenue decline to be able to receive at least something from the CEWS program. As part of the proposed changes, beginning with July 4th, the government is going to implement a threshold in order to qualify for CEWS. So beginning July 4th, businesses are going to need to have minimum revenue decline of 10% in order to receive an amount under the program. And then finally, CEWS for any furloughed employees. So that's any employees that you have on leave with pay. There are some different rules on them in terms of like how the subsidy is calculated. So any CEWS that you receive in respect to those employees, that's currently going to be available until August 28th. I have a little chart here, which shows the proposed extended CEWS periods. So we have periods 17 through 20, starting with period 17, June 6th to July 3rd. This period is, there's no changes from the how CEWS is currently calculated. The maximum benefit you're going to receive per employee is $847 per employee per week. If you if you're part of that hardest hit businesses with over 70% revenue decline, your maximum subsidy rate is 75%. And then for period 17, any revenue decline is going to be eligible for CEWS. Starting with period 18, you could get to see the beginning of the phase out. So the maximum subsidy rate in this case is going to be 60%, with the maximum benefits $677 per employee per week. And then you also see there that's the first period where the 10% minimum revenue decline threshold is required in order to be eligible to receive CEWS for that period. And then moving on to period 19, the maximum subsidy rate goes down to 40% from 60%, leaving maximum weekly benefits per employee to be $452. And then in that final period 20, the maximum subsidy rate will decrease to 20%, and leaving a maximum benefit per employee of $226 per week. So moving on to the Canada Emergency Rent Subsidy, or CERS. So this program was put in place starting in September 27th, 2020. And the objective is to help businesses in terms of their rent, as well as certain other property expenses if they own a building. And similar to CEWS, it is applied for in predefined 4-week periods, and it requires a revenue decline similar to the CEWS. There's a lot of consistencies in terms of between CERS and CEWS in terms of eligibility, how to calculate the revenue drop, and so forth. It can be applied for by the tenant or the building owner, and as some statistics as of May 9th, so CERS has seen 882,540 approved applications from over 180,000 unique applicants, and to date, the government has approved almost $3.5 billion worth of subsidies under the CERS program. So I just wanted to give a little reminder about the eligible expenses under CERS. So if you rent a property, you are eligible to claim your base rent as well as any amounts required to be paid under a net lease agreement. So that can include items such as property insurance, common area maintenance, utilities, property taxes. These are just a few examples. It's not an exhaustive list. So that's what you can claim as if you're in the renting a property. If you own the property as the building owner, you were able to claim property taxes paid, property insurance paid, as well as any commercial mortgage interest that's paid on the property. A few reminders about CERS expenses is that you are eligible to only claim up to $75,000 per business location per 4-week CERS period. And then if you have an affiliated group of companies, they're going to be restricted to claiming at most $300,000 of eligible expenses under the CERS program per CERS period. Just also a couple other reminders. So related party payments are not considered eligible expenses for CERS purposes, so rent paid between two non-arm's length parties, that's not going to be eligible. And as well, the CERS program is not for in respect of buildings that are primarily used to earn passive rental income. So any expenses for that kind of building operation, that's not going to be eligible for the rent subsidy. So the future of CERS looks very similar to the future of CEWS. So again, the current rules are in place until June 5th. And the 2021 federal budget has proposed to extend the program until September 25th, with the option to further extend until November if necessary. Similar to CEWS, we're going to see a gradual phase out of the rate that we can claim under the program. So the maximum amount of subsidy that you can get under the program, that's going to be gradually phased out. And I have a table for you to show in a second. And similarly, there's also going to be a requirement that a business has at least a 10% revenue decline as of July 4th in order to continue with claiming the rent subsidy. So we can take a see here that how the phase out is going to work for CERS. So period 17, that's going to be based on the current rules. So the hardest hit businesses, they're going to be eligible for rent subsidy rate of 65%. And you can, as long as you have any sort of revenue decline, you will be able to claim something under the CERS program. With period 18, we see the CERS subsidy rate drop from a maximum of 65% to 60%, as well as we are introduced that minimum 10% revenue decline threshold that businesses have to have in order to apply for the rent subsidy program. Period 19, we see that maximum subsidy rate reduce even more from 60% down to 40%. And then in that final period 20, it further reduces again from 40% to 20%. Now these rates don't include the additional 25% lockdown support. So if the 25% lockdown support is applicable, so that's going to be for any businesses that are either closed or very significantly restricted due to a public health order. You are still going to be able to benefit from that that additional 25% in full. All right, then next is the Canada Emergency Business Account. So just a couple of small updates here. So the objective of the Canada Emergency Business Account, or CEBA, as we like to call it, is to help businesses pay employees as well as other non-deferrable expenses during the course of the COVID-19 pandemic. And this initially started off as a $40,000 interest-free loan. And if you are to repay $30,000 of that loan by December 31st, 2022, the government will forgive the remaining $10,000. And that forgivable portion of $10,000, that's going to be considered taxable income for your business. In December 2020, the government announced an additional $20,000 expansion for the CEBA that businesses could apply for. So with this additional $20,000, as long as you repaid 10,000 of this 20,000 by the December 31st, 2022, you were going to be eligible for to have $10,000 forgiven by the government. So once again, this $10,000 forgivable loan, that's going to be taxable income for the business. And one last recent update is that originally applications for CEBA were supposed to close March 31st of this year, but the federal government announced that they have extended the application deadline to apply for CEBA to June 30th of this year. So if you are looking to apply for the CEBA loan, or you've obtained the original $40,000 loan and you're looking to get that additional $20,000 expansion, you still have some time to apply for those CEBA loans. Finally, the last thing that I'm going to talk with you all today about is the Canada Recovery Hiring Program, so the CRHP. And this is proposed by the federal government in order to help businesses rehire staff and expand their operations as we look to get ourselves out of this COVID-19 pandemic. So, this is going to be applied for kind of in a similar manner to CEWS and CERS, where it's going to be applied for in 4-week periods beginning June 6th. And the program is going to go all the way until November 20th. And with this subsidy, what it's going to be based on the salaries that a business has paid during a baseline period that the government has selected between March 14th to April 10th of this year. So any wages that a business pays in excess of what they paid in wages for this March 14th to April 10th period, that's the amount that's going to be eligible for a subsidy. So, I mean, very quick example, let's say my baseline March 14th to April 10th wages were $5,000. And then in one of my 4-week periods here during the program's eligibility, I now am paying $10,000 in wages due to expanding my operations. That difference of $5,000, that's the amount that I'm able to claim my subsidy on. It's going to require a revenue drop, which is going to be calculated similarly to CEWS and CERS. We are going to have a maximum subsidy rate of 50% for this program, and this is going to be gradually phased out as well, going down to 20% by the end of the program in November. And the one thing to finally note is that you can claim either this high rate recovery program or CEWS, but you're not going to be able to apply for both programs simultaneously. So businesses are going to need to take a look at, okay, if I apply for CEWS, how much am I going to get under CEWS? And then how much am I going to get under this new recovery hiring program? Whichever one gives me the greatest benefit, that's going to be the program that I apply for. So we're on my final slide here, which covers the recovery hiring program rates. So you can see from the start of the program, so period 17, that's starting June 6th, we have a maximum subsidy rate of 50%, and that's going to require businesses to have a 10% revenue decline in order to apply for that. Now, this 50% subsidy rate, that's going to stay in effect for periods 17, 18, and 19. Once we get to period 20, so that begins August 29th, that's when we will start to see a phase out for this program. So it'll go from 50% to 40%. And then period 21, we'll see that further drop to 30%. And then finally, in that final period 22 there, we will have a subsidy rate of 20%. So that's all I have for the updates on the COVID-19 programs. And I will pass things back to Richard and in order to discuss any questions that we've received over the course of the presentation.
Thank you, Michael, and thank you, Krista. So we have a couple of questions. We'll start with you, Michael. So there's one question regarding CERS, and basically it's with the CERS program, is it possible for the landlord/owner to apply on behalf of a tenant?
All right, so it depends on the situation here. So if we have for instance, some businesses may have a structure where they have their business property in one corporation, and then their operating business in another corporation, and then there would be rent paid from that operating corporation to the building corporation or RealCo. As I mentioned in the presentation, that would be non-arm's length rent, so that rent itself would not be eligible for the subsidy, but the building owner may be able to claim under the rent subsidy for their property expenses based on the revenues of the operating company, with the condition being that at least 90% of the building is being rented out to that operating company. If that's not the case, then unfortunately, then the building that building owner is not going to be able to claim the rent subsidy outside of that situation.
Okay. One for Krista. So the CCA allowance for clean energy equipment, I guess the accelerated rates, would electric golf cart purchases for a new golf course be applicable here?
If I'm being totally honest, I don't know off the top of my head. However, if you are looking to purchase new golf carts and you are the owner of a golf course and you're a CCPC, you may benefit from the accelerated like 100% up to 1.5 million deduction. So if you don't fall into the clean energy equipment, you may just fall under the accelerated rate and be able to claim up to 100% of your CCA in year 1.
Right. Yeah, and my thoughts on that, I would think off the top of my head, I would say probably not, because I believe those classes of CCA are more designed for
Heavy
equipment, equipment that create clean energy, like windmills and what do you call it? The
solar panels.
Solar panels and things like that.
Yeah.
Okay, one more for Michael. This is CEBA.
Okay.
This should be pretty straightforward. So the June 30th CEBA deadline, is that the deadline for the 20K expansion only, or for previously approved applicants who received the 40K, or can you still apply for the full 60K if you are a first-time applicant?
Yeah, so you can apply for the full 60K as a first-time applicant. That deadline is going to be also June 30th of this year. That applies for both situations.
Okay, and then the last question I have is also for Michael. This is a CERS question. Is CERS applicable for a sole proprietorship run out of the owner's home, which they also own?
Right. So with the within the rent subsidy rules, in order to claim the rent subsidy, you have to have what's considered qualifying property, and the definition of a qualifying property indicates that the building and use cannot be like a component of that property cannot be used for personal purposes. So in that instance, your home office there, that's not going to be eligible for the rent subsidy.
Okay, thanks very much. That looks like the only questions we have. We're kind of at five minutes early, so I'm not sure if there's any more questions out there. We can we'll wait maybe a couple of minutes in case there's a few more questions to come in. Oh, one's just come in. Actually, it was a thank you to the question, so it wasn't a question. Oh, well, actually, another one has come in. How does the CEBA program work for sole proprietors who do not have employees/payroll?
All right, yeah, so that's a great question. So you don't necessarily need payroll to apply for CEBA. There's also the non-deferrable expense stream. So that's going to be any pay, like if you, so that can be rent, that can be utilities, that can be any regularly scheduled debt payments that you had to make for 2020. Now, if you have at least $40,000 of those kinds of expenses for 2020, then you're going to be able to apply for the CEBA loan, even if you don't have any payroll expenses.
Okay, one other one for Michael. Obviously, the COVID subsidies are hot topic.
He's way more popular than I am.
Okay, so one other question. Can I switch between the CHIRP, I don't even know how you say the acronym, but
the recovery program, yeah.
And CEWS from one period to the next?
Based on my current understanding of the program, yes, yeah, you should be able to to do that. As you know, so as I mentioned in the program, you know, each period you're going to look at, you know, what's more beneficial for you to claim, CEWS or the hiring program. So you will, from what I understand, you will be able to alternate between the two programs, depending on what's better for you.
Okay, and it seems like that's all we got. So with that, I guess we'll conclude this session. I'm just checking, make sure there's no more questions. Yep. So yeah, no more questions. So I guess with that, we'll close the session, and I just want to thank everybody for attending, and feel free to reach out to Krista, Michael, or myself with any additional questions you may have. There's our contact information on the screen there, and yeah. Other than that, have a great rest of the day and a great rest of the week. Thank you very much.
Thank you, everyone.